I lost everything in 2009 and 10 in real estate. And so that was kind of
Mm-hmm.
like my stumble. They learned probably like I did pretty quick that it's a ton of work. Hospitals and insurance companies and really strong payers on the back end. So those are all three stripe non-correlated resilient private credit strategies which thrive in downturns. I think people are realizing that the age-old financial advisors out there, they saw how the markets have taken swings and they rightfully have some concern today. I think the goal is to make your portfolio impervious to the instability in any one industry. My attempt at trying to make it big and get rich quick, Garrett, didn't work out for me. I didn't become a slave to my investments. So I have the ability now to spend time for my family, my 2.5-year-old. And I think that's part of the other give back is hope people don't not make the same mistakes I did. And
I'm Garret Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Patrick, thanks for coming on the show today.
hey, Garrett, glad to be here. This is going to be it's right up my alley. So talking investing and looking forward to it.
Yeah, no, it's like two analytical people on a podcast together. We're joking in the green room, investing with Patrick, investing to win. But no, it's. I'm really looking forward to it. You have a lot of topics that I'm very passionate about. Why don't we take a step back, as we always do in every podcast, and just introduce yourself, tell the audience a little bit about how you're here.
Yeah, so my name is Patrick Grimes. I come from corporate America, like most of your audience probably. I was a high paid professional in doing machine design, automation, and robotics. I loved it, uh, miss it. I'm full time investing now. Started investing early though. Although I was in really cool projects from robotics with Tesla and companies like J&J and Abbott and Lockheed and Boeing. I found myself kind of wondering where to invest. And I thought that I was going to go heavy into some startups and some of these other gizmos and gadgets and companies that I was getting excited about. But then I took the opportunity to ask the founder of the machine design firm I worked for how he invested, because here's this tech titan, 35 years, and he said, "Well, I invested all in alternatives. Go put it in real estate." And I was like, "What?" He goes, "Yeah, make all my money high tech, but that's a wild ride. You need to put it in something that'll actually generate wealth." So that's what led me down the path. It was a bumpy road, but that's what got me started.
So this is really, really interesting. First of all, I mean, robotics engineer. It's funny because last year I had literally a rocket scientist, a fuel specialist engineer working for NASA. So now I've had a robotics engineer and a rocket scientist. But it's interesting to me being on the real estate side. When we say alternative investments, I mean we're talking like crypto or maybe rare earth metals or something. And so, in your space, is an alternative investment real estate, or maybe you can expand on that a little bit?
Well, yeah. So I kind of followed I lost everything in 2009 and 10 in real estate. And so that was kind of
Mm-hmm.
like my stumble. And I came back into it after getting a master's in engineering and an MBA, trying to follow the breadcrumbs of the wealthy. And so I kind of it was interesting, but I learned about allocation strategies and I learned about recession resilience. I learned about different markets. I learned about different industries. And it did lead me back to real estate, but in places like Houston, where the market was very stable, lots of recession resilience, and where you can buy for cash flow by existing assets. So I started back into real estate, but ultimately the strategy overall wasn't as real estate as an end game. It's real estate as an allocation. I mean, if you look at like Edward Wolf or Tiger 21, these large publications of groups that publish allocations of the high income and the wealthy, it's real estate is really 25, 27% of their allocation. So where are the others? And so the strategy really is something called non-correlation. Things don't rise and what are the investments that don't rise and fall together? How do you build true diversification through investing into completely different markets driven by different fundamentals? And that leads you into other things like legal industry. So we do litigation finance, and we're launching in medical industry as well, and private credit, right? Debt. So there's lots of different strategies here but it's about a balance. It's not about kind of the one size fits all asset class.
Okay. So, I mean, when you say real estate as an allocation, you're talking about like maybe a fund, not necessarily like investing yourself in bricks and mortar, becoming a landlord, property manager, that type of thing.
Typically, people start just like I did with the brick and mortar. They're maybe a high paid professional, super successful, and pretty sure they could dominate the world of real estate by being their own landlord. And they learn probably like I did pretty quick that it's a ton of work, right? And I started out doing machine design, automation, robotics by day, and being successful at buying single family rentals and renovating and refining and renting and repeating, but it just took over my life. So I think that there's a progression where people do end up learning to partner. They learn how to invest in other strategies with experts that this is all they do. And if they're like me, that's where they found a balance, not only in life, but in the ability to reach past having to be active in everything, which allows you to get to other industries which are completely different from one another, right? Can't invest, you can't be an expert in real estate and medical and legal and oil and gas and handful of others, which you need to be in order to be allocated balanced into non-correlated recession resilient investments.
So, just yesterday, I was interviewing a non-traditional investment banker, let's say, and she was talking about, private financing, private lending, private credit. In your space right now, where do you fit sort of into that mold for your company and what you're doing? Maybe I should have asked that question right at the very beginning. What is it that you're currently doing, and what can you do for people?
Well, right now we only have one real acquisitions, which wouldn't be considered a private credit, which is our commercial acquisitions business, which is killing it because commercial acquisitions took a dive. But then we have two active and third we're launching, which are essentially private credit businesses. Whereas in our debt fund, our real estate asset backed debt strategy, we're providing gap and bridge loans. These are less than 60% loan to value. We focus on small balance commercial real estate. It's really opportunistic because the banks have walked away. And so we're help funding kind of an underserved contingent of real estate operators that own 600 to 6 million. Most lenders are not looking at that asset class. And so that allows us to fund those real estate operators. It's a private credit strategy, but you don't want to only be in real estate. So we're also in litigation finance, right? Where, in a similar way with asset backed lending strategies, you have attorneys. And those attorneys, some of them are working on contingency, meaning they believe in the case enough to bank on the win on the back end, the settlement. And when it's very late staged and we can see settlement discussions happening late in the courts, it's very calculated for us to be able to help fund those attorneys after significant journey has gone and provide, just like we do on real estate, provide credit, provide funds for them to acquire claimants or hourly rates to funds to take them across the finish line. And we can participate in the settlements and put a lien. Those are both asset asset classes, which are private credit. And then in the medical industry, we have private credit there too, where there's one business we're working on to acquire practices, but separate from that, which is not private credit, we're working on a private credit solution for medical receivables. This is not funding real estate operators and attorneys, but in a very similar way, we're funding healthcare providers, hospitals, practitioners, those that have done some work. And because of a hole in our healthcare system, they may not get paid for 60 days in some procedures, some 2 years, some 3 years. That's just terrible, but that's just how it works. And so you can fulfill that need by advancing the funds, taking possession over a receivable, and then collecting a pretty healthy return on that receivable with hospitals and insurance companies and really strong payers on the back end. So those are all three stripe non-correlated resilient private credit strategies which thrive in downturns.
Yeah, that's kind of blowing my mind a little bit. And that's why I love this podcast because I mean, I'm just learning tons, right? I mean, I'm learning tons right now. Um, so many different ways the audience can see on YouTube, at least not on Spotify or Apple, that I'm writing notes here. I'll go in reverse order. So when you're talking about like supporting medical and stuff, are you talking about like I'll just use the term buying paper, like, but obviously backed paper where you're doing a little bit of research, and then it's more the struggle is the timing, not necessarily that somebody's not paying and you're buying a debt necessarily. Is that accurate?
Yeah, it's buying a receivable, so there's a position of
Right.
payer there. The good news is, just like in real estate or legal, we have the benefit of seeing what the asset is, what this paper is. We have the ability of doing research to find out if the underlying patient is in fact due this that surgery. Was it not fraud essentially, and was it actually performed? And what are the charge codes associated? And is the underlying payer obligated and healthy enough to pay it, right? And it's unfortunate because it's the answer is yes in those cases, right? Practitioners are not typically in the business of going and doing surgeries they don't get paid for. That's not what they do.
Right. No,
But
of
but I
course
mean,
not.
you can do your due diligence, but unfortunately, they don't have practitioners. Doctors, they don't have the staff necessary, and they can't afford to have the staff necessary because they don't have the scale to really stay after the insurance companies, right? To go through the motions and to potentially litigate needed. And so they tend to just let it ride. And that allows the insurance companies to go what could have been a 6 month or a year to two, three, right? Because they'll wait and delay and defer. But if you actually have the ability to asset manage essentially this asset and get it across the finish line, you're doing a service to the doctors by getting them paid early, right? And you're getting that payment at the time that it is actually due.
Yeah, and then I'm thinking in legal, I mean, so I mean, I believe you said, Patrick, that you're talking about like a lawyer that's trying to push something over the finish line, but it's really about their client's inability to maybe pay because something went past discovery, and now it's definitely like talks have broken down, going to a jury trial, there's going to be another 50, 75, 100K that the client's going to have to spend. Is that kind of a typical scenario?
Actually, not really.
Okay.
So just like in real estate, the legal industry, there's a million ways you can invest, right? And with our legal fund, we're very specific and we spearfish in very narrow set of cases. And I think in every industry, there can be kind of like this super early on high risk. Like I did speculative real estate pre development and lost it all in 2009 and 10. There are people oil and gas wildcatting. There are angel and seed investors, right? But then there's the other side where we're in our real estate fund lending on existing assets. Well, in our legal fund, we're kind of looking for cases in which there are contingency fee based attorneys, and we're lending to the attorneys, not the plaintiffs or the claimant, right? But they have strong assets, they have strong progress on cases or a track record on cases, and typically it really falls into two categories. One is they're a specialist in some kind of case, whether it's sexual assault cases or labor claim cases or some kind of case where we can help them market and add additional people to, and then those individuals that they're targeting, they've done the thorough due diligence to see that, oh yeah, this is actually worth a lot more than the marketing spend, usually about 4 or 5x just on the contingency fee. And to your point, those people can't afford access to justice. Just like how operators can't afford the homes that they're buying,
Right.
will enable them by lending, will enable contingency fee-based representation by advancing the funds and allowing these attorneys. The other side is these mass torts. We don't do class action, but these mass torts,
Hmm.
so tort is just tortum in Latin. It means wrong or injustice, right? And then mass tort means a mass amount of people. So actually the majority of the allocations are in our litigation portfolio, because we have thousands of individual lawsuits, right, to decrease and balance out risk and payout timings. But is that we'll go for these mass torts been going along for 7, 10 years or however long, and we're towards the end. They're literally in this place where they're talking about settlements, and like 97% of cases settle. It's not typically they don't go down to most of the time the insurance companies are forcing some kind of settlement. But
Right. Of course.
um, But basically, when we find out that we're towards the end, these attorneys are saying, "Hey, look, here's where the settlement conversations are," or we've had multiple settlements that are at this price, or in some of our cases, like in Camp Lejeune, they've already published a settlement grid, and they're saying, "Hey, if you can help us out with marketing, we can go find a bunch more people similarly harmed. We're already going to put all the expense forward to do this case as it is, but the more people we get, the more intimidating we are, the more likely they'll settle sooner, and the bigger the pot is for everybody. And they'll take 40% usually of the settlement amount, and our returns would come in a preferred position of that. And so then we'll cross collateralize like all of an attorney's assets, established attorneys, law firm's assets. And maybe there's 4 or 5 cases, right, in there. So it's a little different. I mean, there's a lot to be said there, but in general, what we're looking for is non-correlated, resilient returns where people are they need a place to live in good time and bad times. And at private credit, below 60% loan to value, you've got a lot of volatility there. People need health care. They get sick, they need health care in good times and bad times. And it just happens to be that attorneys, when times are good, they're real busy. And then when times are bad, people get litigious and attorneys are real busy. Right? And that's not like education or HVAC or CPA firms. There's a subset of markets out there which show recession resilience and non-correlation to each other because they don't rely on the same market fundamentals. And you follow that allocation strategy and you add some slices, you end up with a portfolio more like the hedge funds and the sovereign funds and private wealth funds, these ones that understand how to carry wealth through the generations. And that's really what we're trying to create an opportunity for accredited investors to come along.
So there must be a huge due diligence and research component before your fund is willing to dive into, like you said, even year 8 out of 9 on a large tort lawsuit, right? Is there a large research component to these cases?
Yeah, so my in the both on the private credit on the real estate side, my partner's been doing debt for 15 years. My partner in litigation portfolio has been doing litigation funding for 15 years, and same thing on the medical side. So there's a huge decade and a half of track record of and relationships and their boutique industries. And there's a bunch of due diligence. And the due diligence on the real estate side is very simple, really. There's a ton of appraisers out there and people that can go out there, look inspectors. It's a little more challenging on the litigation side. We have to hire law firm evaluation specialists that actually go in and review a docket with a bunch of confidential HEPA medical records, proof of harm and exposure, and then attorney-client privilege documentation. And so that if we're going to do a $2 million investment in litigation finance, it can cost 20 or 30 grand to do the full due diligence, right? Unlike, it could take a lot less than that to get an appraiser, right? Less than 10% of that to do an appraiser for a similarly sized commercial building, right? So it's all just a matter of learning the process and hiring the right kind of experts, just like in any asset-backed lending strategy, to make sure that you are doing your due diligence and making sure that you're making the right investments.
And what is the temperature, if you will, for the accredited investors that you come across for alternative investments versus quote unquote traditional investments?
Well, I think the tables are turning a lot. I think people are realizing that the age-old financial advisors out there, they saw how the markets have taken swings, and they rightfully have some concern today. We just saw the black swan event. Saw real estate interest rates skyrocket. Real estate's been in trouble. People have lost a lot of money in real estate post COVID and commercial real estate specifically, right? They're also looking at the looming inflation. They're looking at BRICS nations, the world's largest economies betting against the dollar. While we're in 2 wars, China's, flexing, and there's
Yeah.
instability in the Middle East again. So any one of these things could cause major instability and have in the past. But the aggregate of all these simultaneous things, while our debt is spiraling out of control, and there's a decline of the respect for the American way internationally, all of these things are happening simultaneously. And so the temperature I see is that more and more accredited investors are starting to have more conversations, like the family offices out there, the hedge funds out there, and they're seeking like, hey, look, if everything in my portfolio crashes, what pieces will still be standing, right? How can I carve out one more piece so I sleep a little better at night? And then they find themselves with a piece in oil and gas and medical, legal, maybe finance, CPA, maybe private credit, real estate, right? Maybe so they find themselves with different allocations and they feel a little bit better.
Well, I think what came to my mind just now is like the word resilient. I think you use that a few times too, because really, I think any investor, I mean, that's why I am drawn to real estate for to a certain extent, being a long-time real estate investor, because as an active investor, I'm talking about, not necessarily as a fund, because as a landlord, I can see the building, I can touch it, I can smell it. Sometimes pre-renovation, not so great, but you know, you're doing your burrs and other things there, your lifts on renos, but you know, and then knowing that at the very end of the day, if it's vacant, you still have this building that's appreciating, et cetera, et cetera. There are other factors, of course. I'm a little biased because in real estate, other than interest rates, property values, I guess, but really what you're talking about, there's so many other factors in quote unquote traditional investment stocks, different things, public opinion. When you're doing your research on a legal fund or you know a medical procedure that's about to be paid by insurance, I don't want to call it a sure thing, but it's definitely, would you agree that there's no outside factors or minimal outside factors that would affect that outcome?
Well, I think they're different factors, right? If you, the problem is investing into the same underlying market fundamentals, right? So the stock market, all the stocks, including the REITs, right? I do whole presentations on how REITs are directly correlated, and the rules of the REITs are one way that they falsified claims of diversification in most stock portfolios. But I think it's different factors, like the real estate, relies heavily on interest rates, right? You're not going to see that in oil and gas as much. You're not going to see interest rates playing a major role in healthcare, right? In our funds in healthcare. So I'd say that it's not that any one industry is impervious to instability. I think the goal is to make your portfolio impervious to the instability in any one industry.
Right, right. The you know, you've mentioned obviously being robotics engineer, disruption that AI is making that might be affecting traditional investments. Where are you sort of on the AI space in terms of your mind integrating into your company, and maybe even your opinion on the disruption that you're seeing out there?
We've done a lot of really fun projects, and just over the last year, we've seen it. Just the stuff that we put in place, new solutions come on that are so superior that it took us. It took us the amount of time it took just to implement AI and learn how to get it integrated and fine tuned. We find ourselves on the other side of it saying we need to do it all over again because the solutions are advancing so quickly. But overall, I think that there is a big component of my investment thesis which are seeking resilience from those things. What are those things still going to be there? Are we still going to have attorneys that need to provide access to justice for those that can afford it? Yes, check. Is AI going to take that away? No. Is it going to make the attorneys much more efficient? Yes, but that they're still going to need the funds to acquire claimants because that takes money. They're still going to need to pay their staff the court fees and filing fees and hourly rates to get it across the finish line. Check. And so medical still going to be there. There's going to be just some disruption as AI is integrated, and I think China just released some of the first fully AI hospitals. Right, there's going to be some disruption, but is the healthcare system still going to have procedures that are physically needing to be done uh, to patients? Yes. Are those bills still going to happen? Yes. And are the insurance companies still going to fight it? Yes. And so is it going to take time? Yes. And there's still going to be a need to finance Doctors, yes. So I take a look at my portfolio, and I guess I'm answering it from a little bit of a backwards way, and we're still gonna
Sure.
need a place to live. Take a look at where we're aiming, and that's potentially why we haven't acquired a CPA firm, because the CPA firm fundamentally, is CPA firms are at the highest risk, I believe, of automation, and we're starting to see a lot of that already. And even in our own firm, we're seeing a lot of that. So there are industries which are going to be, I would say, for the insiders, clear losers. But there are ways within each industry, there are mechanisms within each industry that you can find a bit of a silo where you can still provide a service that is a resilient need that will survive a major AI shakeup. But the AI shakeup's coming, and it's coming faster than we can even implement stuff in
Yeah,
the business.
a year ago, some people are just like, AI, what's that? And then 2 months later, oh, I think I know how to use ChatGPT. And now you look at what we're talking about today, full robotics. I mean, I know that my profile says I'm in real estate and property management, but I'm currently just on the beginning edges of starting a roll up with sort of grass and snow, right? Grass cutting and snow removal, because I'm up here in Canada, so that the season kind of seamlessly goes right from one to the other. It's about 6 months and 6 months. And so I'm choosing that industry or anything almost in home services largely because it's AI proof. And I know lots of people are doing accounting roll ups. And yeah, you kind of just gave my head a shake there because I was just speaking with somebody yesterday, and it was this like a martial arts studio owner. And he was asking me, yeah, there's this platform out there that can do all your books for you with AI. Would you trust it? And I didn't even know that was out there, but now that I'm thinking about it, why wouldn't it be? But if that does exist and it's just as good, it's going to disrupt the accounting industry, like you said.
Yeah, and it could just make it a lot more efficient. So it's what side you're going to be on, and whether or not, if you're going to invest into the efficiency of AI in an industry, can you be enough in the lead? If you're going to highlight the CPA, firm, the prospects there, there's a massive shortage of CPAs right now, and there's
Yes.
far more retiring. So there's actually the ability to gobble up CPAs. The problem is CPA firms. The problem is you can't replace those people. So any CPA roll up where you're acquiring and you're losing somebody who spends 80 hours of their week during the tax season and has for the last 40 years, you're going to need three different people to
Yeah.
then take all those clients, because they have to start over from scratch with all these, and then they
And the
have to,
energy of a founder, don't forget that,
yeah, and
right?
the energy of a founder and somebody who's knows these books of these clients and they has been doing it for decades. That kind of, so where are those three? They're not. There is no three CPA firms, CPAs out there. They're just not going to school. In fact, there's just massive disparity. So the prospect of doing CPA roll-ups has to require a combination of outsourcing to India and the Philippines, which is where there's a very strong American CPA education, and the implementation of technology to make it very efficient. In the process, you decreased that brick and mortar personalized experience that these
Yes. The
individuals had, and that
relationship,
trust and that
right?
relationship.
Yep.
And so you look at you really have this like diminishing return where you're like, oh, we're gonna buy this, but now we have to one dude for three different, now they don't even exist. We have to now inefficiencies overseas, implement a bunch of technology only to lose that customer base, because they're like, well, maybe I've been wanting to change for a while, but you've given me a reason now. So it's there's a lot going on there, and it's not easy in that space to navigate it. We've looked at it real hard. So, and I'll tell you what, the bigger guys are implementing a lot of technology very quick, and they're becoming much more efficient. And they have, their tens of millions of dollars are being put into by these AI tools, and it may not be that you ask the question, do you trust it? It may not be that that's the right question. It's,
Yep.
does it get it to 95% or 99%, so that an attorney can spend, instead of 4 hours on your return, they can spend 20 minutes reviewing it.
Yep.
And quite honestly, that's how we work across our business now. I don't spend 10 grand to work on agreements with an attorney. I use AI to help me refresh and modify old agreements. And then I submit 95% completed documents to my $600 an hour security attorney. and he goes through and reads them, so now it's not, here's fixed fees, 10, 20 grand for agreements, here's an hourly rate, and here's just what it took to complete it. That's
Yeah,
where we're headed.
I'm doing the same thing on legal, and I think in a large part, although I don't know, I haven't interviewed any attorneys lately, but I don't want to use the term disruption, but certainly they're going to see their billable hours annually go down because of it. I mean, you can almost pin. I'd love to see the data, right? I'm a data guy.
Yeah.
Love to see the data when ChatGPT came out, and then there's better. I don't want to argue platforms, but you put a pin when ChatGPT came out, and then you start charting the billable hours on just even the attorney industry, right? And attorney law, contract law, all those types of things. I would bet money that the hours are lower for sure.
On the younger generation, guys that have younger clients, like me, or tech savvy
True
clients.
enough. True enough. Yeah.
Yeah.
True enough. Yeah, that's
Yeah.
fair.
Mhm.
Did I hear you say earlier that you're also participating in a roll up, or maybe that was really quick at the very beginning?
So I've looked at a few different roll-up potentials, probably about half a dozen. And at this very present moment, I do not have a roll-up strategy. I feel like that is a bet on a hope of an economy being somewhere where valuations are where they are today. So fundamentally, I want the businesses created to support their business plan based on the economics of what we can accomplish, and not kind of on a hope of a future exit. Um, so, eh, could there be roll-ups? Yes. Is it part of our business model, especially our projections? No, right? Could it happen in the future? We're looking at medical on two sides, practice acquisitions as well as financing. I like the financing. I think is really resilient, and practice is much more particular, right? Lots of cash flow though in those, and there's a gray-haired tsunami happening, right? The gray tsunami where so many practitioners are retiring. The new ones don't want to go work for a big hospital at 200K. They would rather work at a practice for 4 or 500K. They just, don't want to do the work. Can that work be done by managed services? And there's really interesting strategies around both of these businesses and medical side that make it really interesting. And could that be a roll up? Absolutely. Is that a strategy that I would put down on paper? No, because it needs to fundamentally be supported not by a hope and a wish of a talking to a guy who's lost it all in pre-development,
Yeah.
not by a hope of exiting when appreciation
Yeah.
happens and you can build later. It needs to be executable by basic fundamentals that are available in the business plan today.
Well, I think to your point, it's a lot different than myself as an operator and trying to be the platform company and acquiring portfolio companies in a roll up in a traditional sense, compared to having a fund and having to choose to invest in that, like maybe a private equity or fund or would do. And that's a completely different ball of wax. You know your lane, you're sticking to it. And yeah, I agree. The roll ups is a little bit of hope. Just backing up there for a second, when we talk about AI, I've had the opportunity to maybe even, and I've thought about starting up a roll up with AI companies or even an AI company. And to me, Patrick, it's just a race. And who are you competing with? I mean, Musk, Grok, Gemini, OpenAI. It's crazy the amount of money that these companies are spending, not even on R&D, but acquiring other companies only to get the founders and the intellectual property housed within. I mean, and that's just within the last couple of months. It's crazy. It's absolutely crazy.
Uh, yeah, I don't know what the opposite is. Because I say investing in office space in urban areas right now is like catching a hot knife. It is. There's just really no solution, and it's just dropping. I don't know what the opposite of that is with investing in AI. Because just as fast as that hot knife is falling in office space, AI is just skyrocketing, and any particular startup, any particular roll up could find themselves overnight out of business because of the dramatic advancements that are being made that just are mind blowing. And we're to the point where the AI models are creating better AI models. And it's just going to be incredibly hard to predict that. And the engineer in me can't seem to calculate a safety factor, right? A risk profile for investing in industries that are, you know what? I've done my attempt at trying to make it big and get rich quick. Garrett didn't work out for me. So,
Well, I mean, I think failure breeds success, though, right? I
mm,
think, you see successful people and you hear the term, oh, they got lucky. A truly successful person is not lucky. They got there through hard work, and what you don't see are the battle scars underneath,
mm,
right? But they do make you more resilient. And I don't know that I don't know a single successful person that hasn't been like really, literally, almost like close to bankruptcy or not knowing if you're going to be able to make that payroll. You know what I mean? So it's we've all gone through it, right? We've all gone through it.
I've been in enough investments and partnerships to know that I should have been in a lot less investments and less
And
partnerships.
partnerships. I've had so many bad partnerships. You'd think I'd learned my lesson. I'm very anti-partnership right now, which doesn't bode well for me because I just find that maybe I am giving up opportunities, but it's like being separated. You don't want to date again or something like that, right? Or you get into a really bad car accident, so you don't want to get behind the wheel of a car. I think you just have to just find better people in which to do business. Um, I was going to ask Patrick, just for people, because we've been talking about a whole lot of things, but in terms of alternative investments, let's say that my audience here at Investing to Win, a lot of traditional investors, real estate investors, business people, intelligent people. What are the pitfalls that you might, let's say somebody is inspired here and wants to start their journey into alternative investments? Any warning signs, any words of advice that you might give to somebody who's just trying to invest a few dollars into it?
Yeah, so I mean, I was once there, and I just didn't have the knowledge. I kind of ventured out into whatever I could find, which is very limited. And I followed just a few referrals of people that I knew instead of really taking a hard look. And so I actually created a mastery series, an alternative investing mastery series, because I just feel like there's just no place people can go and learn about all the different kinds of alternatives. And that's what I tell people to do. And there was no way to go do it, even though I was telling people to do it. So I say that there's really like three steps that I say. I say do one passive step a day. That's There's no excuse that you for not doing this. You could be at the grocery store, driving in your car, at the gym, but engaging in some kind of content that grow your understanding of alternatives. And I have a series for that, our alternative investing mastery series, where every 2 weeks we dive into completely different asset classes or strategies, tax strategies. And so that's what we do at passiveinvestingmastery.com. We educate. So they or go to download some books in investing, right? Download some leadership books. So I run every morning, and that's when I take my time to start my day with a leap in my passive education. Okay, then it take one active step a week. That's get physically in front of people at least once every 2 weeks, but if not every week, find a meetup, call somebody that's succeeding in the business, set up a coffee. I mean, find those real estate, find those alternative investing, find it. And I don't like Zoom as much because it doesn't get you out of your comfort zone. It doesn't get you out of your house. It doesn't get you in a space in which now you're bonding with other people and seeing and creating relationships with other people that will last, that are succeeding in doing things differently. And the problem is, if you're going to venture into the alternative space, typically that means you're not supported by a bunch of people around you because most people are not doing that. They're heavily weighted into highly volatile stocks, right? And they're going to worry about you and to pull you back. So then the human condition isn't designed to step out into the wilderness or go into the forest or the desert all on your own. Like, we are nomadic, we're tribal. So find your tribe. And educate. So every day, educate passively, every week, or at least every 2 weeks, physically get in front of people, maybe alternate Zooms if you need to. But then start taking action. Set a goal like 90, 120 days, make your first investment, and start slow if you need to. But the point is, you're never going to get there if you never play. And most of the experience comes from taking action in this world. And that's kind of what I tell people, what how to go about eventually breaking your way into the space.
When you just made that comment on Zoom versus getting in front of people, I kind of chuckle because after COVID. I mean, one of the, I guess, good things is that we have Zoom and remote work and gig economy and things like that. One of the bad things is remote work and gig economy. And I can't tell you how many times I'm in a Zoom meeting and it's on one screen and I'm doing work and I'm half listening, right? Well, that's not going to bode you well. Maybe it's okay if you're listening to a manager like or owner like myself drathering on about a property management process, but not when you're really truly trying to learn. And one of the things that when I did my research, you're a best-selling Amazon author, Forbes Council contributor, is credibility, right? For anybody listening out there who are trying to search out, like for your passiveinvestingmastery.com, for sure, we'll put that into our show notes. I think that's a great thing that you're doing, giving back like that. But for somebody who's venturing out, they don't know who's credible. How do you know they're credible? Even, or if you're, it's like you, how do you create that credibility?
Well, how do I create the well, I didn't do a good job of it in the beginning. I kept everything kind of a secret. I was an engineer. I was part-time investor, and I didn't tell
It's
anybody
kind of
about
in your
anything.
DNA.
Yeah, I mean, I had had, I think, a couple thousand units, in apartment buildings before I even told my friends and family what I was doing, and but I went to an event and somebody said, "Hey, look, you need to get your story out there," right? And I was like, "No, I'm an engineer. That's my story." He's like, "No, no, man, you're an entrepreneur, you're an investor. Get out there, tell people what you're doing, it'll inspire 'em." So that's when I participated and I contributed to my first book, and I really kind of ripped that Band-Aid off of being vulnerable, telling my story, talking about my losses. And I think when you talk about your failures and you're honest and you talk about, what you're doing and why, then you elicit feedback and people start resonating, and then I get to grow because I mean I'm leaving Monday for a mastermind where there's about 20 of us. It's an invite only thing and we've all been very successful in alternatives. And I'm going to engage with those people, get vulnerable, talk about what we're trying to do, talk about our struggles. And I think when you get like that, that's when people will lift you up, right? And that's when people will start to believe and trust in you. I did start writing a lot because I felt like I was in 1,000 investor calls, and there's everybody's got their own unique situation, but there's a lot of similar themes. And so I started writing articles in Forbes, started doing webinars specifically on topics that keep coming up, like how to do 1031 exchanges, or how to how to
Hmm.
do asset protection, or how to invest through IRA and 401ks. I got Forbes articles on all that stuff, right? So all kinds of things. Um, and so I started writing, doing webinars, and now I'm speaking on stages and either virtual or live on stage at least once a month. And it's been fun, right? I'm invited to contribute to a couple of best-selling books. It takes a lot of effort, and it takes the desire to want to get vulnerable and get out there and to be transparent. And then when it comes to evaluating other partners, I mean, I trust but verify, in all of our
Yeah.
agreements, you need full transparency. And signing, like right now, I can see, and I'm a part of every single aspect in terms of visibility, trust, but you delegate but trust, verify. But I also run background checks, very simple thing, and that saved me on a couple partnerships where I ran them, and I always ask, do you have anything to disclose? And then some stuff comes back, and I'm like, more so, why didn't they disclose this? What else
Hmm.
is it lurking that they're not, why are they not being transparent about things that could be a concern? And I think those things have really struck me, actually calling and speaking to other people that have invested with them, and asking questions. I bailed on a carbon capture investment, which ended up being a Ponzi,
Oh,
and
wow.
I asked him questions like, "Hey, how is it? I'm an I-paid professional. Sure, I love this 250% tax write-off. But how does that even work?" Right? He's like, "Well, you're GP, you guarantee these loans, and you to that extent." I was like, "Wow, that's scary. Can I see the loan documents for what I'm guaranteeing?" And they were like, "Well, we
Yeah.
don't have time for that." I'm like, "What do you mean you don't have time for that? You want me to put myself out there for two? What are the carve outs? Like, what are the like?" And he was like, "Well, I'll get back to you when I have time." I was like, "This guy is an asshole and a jerk," right? I'm
Yeah.
like, "These are really," and I'm the enemy. Fast forward a year and a half, 2 years later, find out it was like a $400 million Ponzi. Ask very simple questions, and if
Yeah.
they don't treat your and if they show you their true colors, believe them. believe him. Like, just walk away. Don't have FOMO. Just walk
Yeah.
away. And unless somebody takes the time with you, I join a part of every investor call, and investors have my number. But unless they have the time for you when they're looking for your capital and times are good, you better believe they're not going to have time for you when things are not looking good and times aren't great, right? So those are, that highly transparent, answering questions, being very accessible, doing your background checks and your references with other investors. I think those are all key aspects.
Yeah, my mentor always says, if you're going to be, I mean, this is what you're doing, Patrick. You're the steward of somebody's money. They're entrusting you with it. And that steward better treat that money better and protect it with their life better than their own, or there is no credibility. Um, I know people who have lost money for their investors, and even though the agreement said they didn't have to, my mentor paid them back out of his own pocket because that was a trust. And when things got better, guess who was still investing with him, right? Those exact same people, because you have to stand up when you're called to the floor there. I could go on and on. This has been really, really good, but I know that we're almost at the top of the hour. Um, I always ask every guest the same question. That's kind of unique about this podcast. So, because the answer is always different. So, I'm going to ask you. So, this is the Investing to Win podcast. How do you define success, and what does winning look like for you?
Well, winning looks like for me, and me and my wife have had this conversation because we were able to get to location freedom where we're now in Honolulu. I was able to get out of the high tech world demands, get into my own position where I have more time freedom, and I can spend that now. I can balance. I didn't let my investments I didn't become a slave to my investments. So I have the ability now to spend time for my family, my 2.5-year-old, and friends and hobbies. And I found that balance between my wife and I, where we get to take time for us. We get to not have to be on the road all the time like I was as an engineer, take time with my boy, and then really spend time doing things that make life worth living. And I think those are the things that, and then I guess the other component is to give back, right? And that's our whole platform of passive investing mastery, is just like, when I was an engineer, I was getting involved. I wish I had somebody saying, hey, here's not the 50 stocks, but here's the 50 kinds of alternatives that are non-correlated to the stock market, completely different stuff like gold mining and Forex and ATM machines or whatever, like a bazillion different things out there that, bourbon barrel cask investing, timberland investing. And how do you even get into the AI investing? How do you even get into these things? And what are the pros and cons? And just a ton of different stuff out there that's super fascinating. And I wish that I had it. So that's what we created. And I think that's part of the other give back, is hope people don't not make the same mistakes I did, and help get them the right options in front of them because nobody else is going to do it.
Yeah, you mentioned Honolulu. I wasn't going to do it. I was just thinking I was going to give you the gears about it because I love Hawaii. We were talking about that in the green room. But in all seriousness, I had an interview just before this, interviewing a potential staff member, and he's got a young kid, right? And you know, I know we just have a couple seconds left here, but very briefly, when I was going through my big phase there, like I bought 43 properties in 10 years when I started when I was 27, 75 doors, all while working a full-time job. And I was grinding and grinding, and then I have two boys now, but at the time, my first son. And so I go back home after 6 months of working full time, taking my painting clothes with me. You know the drill. And he played shy, 6 months old. And that happens to any parent who's been, there's always a primary caregiver. And it's like a knife through your heart, right? But the point of the story is my former business partner at the time didn't have kids. And he said, don't, like, I was really upset. He said, don't worry about it. They're not going to remember when they get older. And whether that's true or not of a 6 month old, I'll leave this with the audience, but I'll remember, right? So for anybody who's out there listening who thinks you're going to grind and grind, yes, you have to. You have to work as hard as you can. And there's not necessarily going to be work life balance, but just be present when you need to be present. And I mean, I took that lesson right to heart back then. So I love what you just said.
Great.
All right. So thanks for coming on the show. I'll put everything in the show notes, and yeah, we'll definitely keep in touch.
Thanks for having me, Garrett.
All right. Thank you.